Hey, what's up you guys? It's Michael here, and today we're going to be covering a highly requested topic about an extremely popular way to generate passive income in Australia, which is through the use of high yield ETFs or dividend ETFs. It's the concept where you can essentially do nothing all day while you sit at home and make money from anywhere in the world. And it's an interesting idea to say the least. After all, who doesn't want to make a lot of money without having to work? The good news is that there really is quite a few different dividend-focused ETFs available in Australia, and they're great because they don't involve a lot of work to manage, like many other so-called passive income streams that gurus will try and sell you. They truly are sort of set and forget once you purchase them, and you accumulate more of them over time. I do want to be upfront with you guys here and let you know that these dividend ETFs aren't going to make you filthy rich just overnight. However, the good news is that they will provide you consistent income over the long term, where if you continue to increase your position in these ETFs over time, you can eventually reach the point where dividend income will be enough to cover your expenses and a lot more. Now, I'll be going over several different dividend ETF categories today in this video, so you'll be able to find something that is suitable for yourself, whatever your circumstances are. And I'll be breaking down the best dividend ETFs in the following categories: the best Australian dividend ETF, the best international dividend ETF, the best actively managed dividend ETF, and then finally what I consider the best overall dividend ETF available on the ASX. And the one I've selected for best overall might actually surprise you, so do stick around to the end to see that. I've omitted real estate investment trusts or REITs for this video, as I actually want to cover them separately because they are pretty unique and there is a few nuances there that I would like to cover in detail. However, in saying that, I wanted to be extremely thorough in how I looked at the different dividend ETFs that I'm going to go through today. So the criteria that I used to actually evaluate the different options were the size of the ETF, like the actual funds under management, as this will actually influence the liquidity of the ETF, which impacts when you're buying and selling. I looked at the management fee, as it is the one variable that you are able to control as an investor. And I looked at historical returns, both from a dividend perspective, but also from a growth perspective, as capital growth returns are quite often something that's overlooked when people are evaluating dividend ETFs, but they're actually very important. If you think of a dividend ETF as this honey pot that spits out a portion of its sweet honey every quarter, or whatever period that is, imagine over time if your honey pot keeps reducing in size, that portion of honey that it can keep providing will keep reducing, and eventually you won't be getting any more honey at all. As even if your dividend yield is remaining stable over time, if your capital growth is negative, then your dividend income will actually be reducing every single year. I hope that example made sense because it's actually a pretty important concept when you're thinking about dividend ETFs. Hey, and just before I get into the video, if you enjoy this type of content, I would really appreciate it if you can smash that like button down below for the YouTube algorithm, as it really does help me out a lot, and share this video to other people. Now let's jump straight into it with the first category, which is the best Aussie dividend ETF. So the vast majority of dividend ETFs on the ASX are focused on extracting dividends from Australian companies. And this isn't really surprising if you think about it, as Aussie companies are way more likely to pay out dividends than global companies. There's also a much bigger benefit to shareholders from Aussie dividends, as they are usually franked, which means you'll also get a tax benefit in addition to your dividend payment. So the ETF that I think is actually the best for high dividend growth from Aussie companies doesn't actually have the highest pure dividend yield out of all the ETFs I looked at. However, it was the only option that I looked at that had a positive capital growth return since inception, as all the others actually had negative capital growth returns. And like I mentioned previously, there's no point having high dividend yields if each year the income is actually reducing because the size of your overall pot is getting smaller. So this ETF that I'm actually talking about is the Vanguard Australian Shares High Yield ETF, or VHY. To start with, VHY is by far the most popular dividend ETF on the ASX. Like, it's not even remotely close. VHY actually has over $1.3 billion in funds under management, with the next closest being IHD with only 281 million, not even a quarter. In fact, the next four most popular Aussie dividend ETFs combined still don't even come close to matching the funds under management of VHY. So you can see it really is extremely popular. And there definitely is a few reasons why it is so popular, which I'll dive into. But the first and most obvious reason is that it has the lowest management fee out of all its competitors at only 0.25% per annum, with the highest actually being ZYAU at 0.35% in this Aussie Dividend ETF category. And I actually noticed that there's a direct correlation between the management fee and then the funds under management with these dividend ETFs, or how popular the ETF is, which is actually an interesting thing to note in itself. Now, the next thing to note is that all of these dividend ETFs are actually tracking different underlying indexes. The one that VHY tracks is the FTSE Australia High Dividend Yield Index. And this index basically tracks companies with higher forecasted dividends relative to other ASX listed companies and excludes any REITs. And if we jump into what I'm sure what most of you guys are quite interested in, which is the performance of the ETF, we can see, like I previously mentioned, that since inception in 2011, VHY has had a slight positive capital growth return of 0.32% per annum, so more or less the same, which is important to ensure that your dividend honeypot, like I mentioned, isn't shrinking in size over time, so that that dividend income actually remains stable over time rather than reducing over time. And then what's really great is that the dividend income return has actually been over 6.39% per annum since inception, and they're paid out quarterly. So this is actually really high. And the franking level varies each year, but the last couple of years has been around 90%, which makes it really a great option for Aussie investors on the ASX. And finally, it has the highest number of holdings out of all the Australian company dividend ETFs that I reviewed, with 66 at the time of recording this video, which means that it provides really decent diversification. However, do note that the top 10 holdings do make up 68% of the ETF, so it is a little bit top heavy. All in all, I think it's a great option for any investor who wants those franking credits and wants high dividend growth over time, whilst at the same time making sure that their actual capital growth portion of the dividend ETF is not shrinking, which means they'll have stable dividends over time. So moving on to the next category, for people who would rather look globally for dividend incomes and don't necessarily need or want franking credits, there's actually far fewer international based dividend ETFs on the market, especially on the ASX. However, there are still some good options which I'll go into. There really are sort of two main ETFs to consider on the ASX if you want dividend income via companies around the world. On one hand, there's INCM from BetaShares, and then on the other hand, there's WDIV from SPDR. However, when you're actually comparing these ETFs side by side, it really does make it clear that I think WDIV is the best option out of these two. Firstly, the index that WDIV tracks, the S&P Global Dividend Aristocrats, is actually designed to follow companies that have a policy of having stable or actually increasing dividends over a period of at least 10 years. And the ETF actually has a solid track record of returning 5.54% per annum in dividend yield since inception in 2013, paying semi-annually. And again, another positive with WDIV is that since inception, capital growth has remained steady at 0.07% per annum and not lowered over time. Compare this with INCM from BetaShares, where its index and ETF have actually only been around a couple of years, so you don't have much sort of a comparison to go by. And the only comparison that you can go by is that after 1 year, it's actually lost quite a bit more than WDIV in that same period. So I'd really have trouble recommending it for this particular category. The management fee of WDIV is 0.5% per annum, and its holdings are well diversified across many different sectors and countries. I really do think it's a good option for investors who want strong global diversification for their dividend income and aren't really concerned about receiving franking credits, as it's had a strong track record and only invests in companies that have had either stable or growing dividends over the long term. So as you guys know, I'm typically not a massive fan of actively managed funds because I think the fees are too high generally and it's typically not worth it. But I do think there are some cases where it might be worth it. Specifically, if you have some requirements out of your investments, like you want low volatility or maybe more tax efficiency. And these are actually two benefits of what I consider to be the top actively managed dividend ETF on the ASX, which is the BetaShares Leg Mason Equity Income Fund, or EINC. EINC actually only invests in high quality shares and does not use derivatives to generate income. Also, the fund aims to maximize the benefits of franking credits for investors, so great for Aussies, and the fund's active management approach targets sort of lower portfolio volatility than the overall S&P and ASX 200 index, and also aims to be less concentrated in single stock or single sector exposures, so it aims to be a bit more diversified. EINC has only been around in its ETF form for a couple of years. However, the managed fund version, which isn't listed on the ASX publicly, has been around since 2011, and since inception has actually returned 7.28% per annum, with around 5.5% of that being from dividend yields. The franking level has also been extremely high at 96%, so they're definitely achieving their goal of high franking credits, and their dividends are actually paid out quarterly. So the management fee is quite high at 0.85%, but relative to other actively managed funds, this is actually not too bad. So my final point I want to make about EINC is that it's really suitable for investors who are looking for tactical exposure to tax-efficient Aussie equities that want to ensure their core equity holdings that provide these dividends are not shrinking over the long run, which is really important, like I've been trying to say throughout this video. So here we are at the best overall dividend ETF on the ASX in 2020. And like I mentioned earlier, this one might actually surprise you. I've kind of hinted throughout the video that when you think about dividend income, you need to also be thinking about that capital base. Because if your initial allocation of capital towards dividend ETFs is shrinking over time, your dividend income will also be shrinking over time, even if your high yield percentage is actually stable. In saying that, what I do think is the best overall dividend ETF is actually the BetaShares Australia 200 ETF, or A200. Firstly, it has an ultra low management fee of only 0.07%, which is actually lower than its main competitor and the most popular ETF on the market, VAS. Secondly, it's tracking an extremely old index, the ASX 200, which tracks the top 200 largest Australian companies on the ASX by market capitalization. So we can really get a good idea of long-term performance and historical returns, which is good to know. However, I'm sure you're thinking to yourself, A200 is not a dividend ETF. Why do I think it's the best overall dividend ETF on the ASX? So I know my recommendation might seem a bit controversial, but let me explain my reasoning. If you actually look at the ASX 200's capital growth over sort of the last 10 years, a really small proportion of its overall growth is actually from capital growth at only 2.8% per annum. And when you compare this to its overall growth, including dividends and also including the benefits from franking credits, which are normally at about 80% franked, we actually get 8.98% per annum for the last 10 years, which means that 6.1% of the total return from ASX 200 every year is actually from dividends, so a vast majority of the return. So not only is this figure alone extremely high, but do you remember how I was talking about that honeypot example earlier? Well, in the case of the A200, not only do you have a honeypot that is providing you with a lot of dividend income each year, well, at the same time, instead of your honeypot at least staying the same size, it's actually growing over time by almost 3% per annum. So this actually means that if you didn't reinvest any of those dividends you got paid each year from A200, your dividend income would actually keep increasing each year because of this capital growth. And you'd actually be able to get a similar benefit from any Aussie shares-based indexed ETF. But the reason I like A200 is because it has the lowest fees. So there is some downsides, and the main downside really is that there isn't really any global diversification from A200, and you are quite exposed to a few sectors like financials as well as resources. However, if you are looking for passive income through dividends, which are paid quarterly, which are likely to actually keep growing over time, then I think A200 really is a great choice. So there you have it, guys. That's my top dividend ETFs on the ASX in 2020. But with that said, please just remember that passive income through dividends is not going to give you a lot of money initially. It's not going to be like printing Lamborghinis every month without a significant amount of time and capital. However, dividend growth investing is a solid foundation for any long-term passive investing strategy and is proven to provide returns over the long term. So for this video, it's not about getting ahead of ourselves and trying to get really big numbers off the bat and totally confused about how to get there. It's all about dipping in your toes, figuring out what works, and just starting. It's going to be slow up front and it's going to take a lot of time, but in the future, it's going to be worth it if you just start today and smash the like button for the YouTube algorithm. So with that said, guys, thank you so much for watching. I really appreciate it. And as always, please make sure to subscribe and hit the notification bell as I'm posting videos every week. Otherwise, drop me a comment and let me know what you'd like me to cover next. And until next time, peace.